Welcome to ETF Market Insights, the ultimate destination for Canadian DIY investors eager for the latest on ETFs and the economy. Join us every week for timely insights and actionable strategies, all brought to you by BMO ETFs and our experienced panelists. Don't forget to subscribe, and let's jump right into today's episode.
Welcome back to ETF Market Insights. I'm Erin Allen, and today we're going to be diving into one of the most popular, maybe widely recognized benchmarks in the world, and that is the S&P 500 index. It's definitely a household name for a lot of investors. We see it all over social media. I'm very active on social media. I see it everywhere. And a lot of people think of it as sort of the pulse of the U.S. equity market, but we're going to get into what exactly it is, how does it work, and I guess at the end of the day, does it live up to all of the hype? So we'll break down the methodology, how companies are selected, and explore sort of what that means for you as an investor. Before we get started, a quick reminder that we're not providing any investment advice or recommendations. Today is just all about education and information. And joining me today is Joseph Nielsen from S&P Dow Jones Indices, who brings deep expertise in both index construction and performance, which we'll get into. We're going to dive into, as I mentioned, the S&P 500, but we're also going to break down the latest from SPIVA and the scorecard results, which really aim to reveal the difference between active and passive investments when it comes to performance. So welcome back, Joe. Thanks again for being here today.
Thank you, Erin. It's always a pleasure.
Let's dive right in. I'm hoping we can kick things off and just sort of give us the quick overview of what the S&P 500 index is, so we can all kind of be on the same page here.
Sure. And I think it's something we've all lived with a long time, whether people call it the S&P or we just call it the 500. It lives in financial language for years. And just a brief bit of history, as we know here at S&P, the index business goes back into the 1800s. The S&P 500 itself, its kind of origin was around 1923 when there was a tracking of about 233 stocks. It wasn't called the 500 yet, obviously, but that was a weekly measure that about 3 years later went to a daily measure of around 90 stocks. And then over time, that the number of securities grew and the frequency of calculation increased into what we have today as the S&P 500 started in March of 1957. So there's a long history there. That allows a lot of analysis, and I think that's why a lot of people use it, whether they're watching or investing in the market. Now, where it is today, and where it has been, is over a course of evolution of the markets and stocks coming in and out. Importantly, with the 500, there's an index committee that ultimately decides what goes in, what goes out, and when around rules that they decide, and some of which are transparent and open to people. As you can imagine, everyone would like to know who's on that committee. It's not disclosed right there because a lot of people want to know how does my company get into the 500? There is no answer, so don't give me a call about that. But what I can tell you is that some of the requirements for new entrants are interesting. Like, for example, a company needs to be included in the 500 for the first time. It needs to have positive earnings over the most recent quarter and over the sum of the last 4 quarters, right? So already you're having a screen there for some kind of quality. Company has to be U.S. based, headquartered in the U.S. and primarily listed on a U.S. exchange. It has to have sufficient market cap, so it's a large cap index, right? That changes over time where that threshold is, but it was around 23 billion in July, for example. And liquidity is important; it has to be highly liquid. And the way that the index works, it's looking at float adjustment as well. And so you might have a company that's large. And in size and public, but if most of its equity is not traded, if it's held by founders or other entities that don't put it on the market, that would impact what we call that float adjusted market cap. Now, lastly, the index does evolve as companies evolve too. There will be mergers and acquisitions, or bankruptcies and things, or changes in structure that can lead to a company being delisted and replaced with another. And finally, if you do see more than 500 tickers from time to time in the 500, that is because you have a company like Alphabet, for example, that has multiple share classes. We might see that in some cases where the number is slightly different than around 500.
That's a good point. I get that question a lot. When we look at the holdings of an ETF online, it often shows 503 or 504, and so that's good to clear up for sure. You mentioned market cap weighting, and there's a lot of different ways that indexes and ETFs are weighted. Market cap, probably the most popular. There's also equal weight, there's yield weight, the list goes on. But why is it important to understand that the S&P is market cap weighted, and how is it really impacting the market or the index today as we see it?
Sure. Yeah, so market cap weighting, I think, has kind of a philosophical simplicity and also an investment simplicity. And from a kind of philosophical standpoint, really just more of a monitoring the market standpoint, what does it tell you, right? It's the sum of all of the market caps of all of the companies that you're exhibiting. That tells you essentially the total value of the stock market, right? If I want to see the total value of the market, I take each company and multiply its shares by the price and add those up. So it's very simple. And I think that makes it also very comparable over time periods, right? You can see today versus any date in the past, how much has the market grown by looking at the market cap of the 500, for example. So an economist or a journalist or anybody measuring the markets might want to use that very precise way with the standardized history, right? Now, when it comes to implementation in an index fund, as you know very well, this creates a bit of ease for the managers. Now it takes a bit of skill to manage even a cap-weighted index fund. We know this, but from a turnover standpoint, there's not a lot happening, right? You're letting the collective wisdom of the market determine what each stock is worth. Its weight rises and falls. That doesn't require PMs to do constant trading. The only time they really have to bring security in or out is when there are changes in the construction, right? Additions or deletions. And so cap-weighted indexes are simple in that standpoint, and we've seen through some of the work we've done on SPIVA, which we'll talk about later, for example, we've looked at post-tax SPIVA as well, and you see funds that have a lot of trading activity are generating taxable gains. Cap-weighted index doesn't really do that, and so there's an advantage there from a simplicity and implementation standpoint.
I guess one of the maybe criticisms of a market cap weight is that it can often lead to concentration, and we're seeing heavy concentration in the S&P 500 in the Mag 7, or these giant tech stocks. So can you talk a bit about how that looks today relative to historical norms? And, in your opinion, does this raise considerations that investors should be thinking about when it comes to diversification of the index?
Sure. Yeah. So the concentration is there. And if you're referring to the smaller number of stocks that constitute a larger portion of the weight, we could talk about that. There is some precedent. When we started to get into the situation we're in today, we look back and saw, probably in the 1970s, the last time that we had this level of concentration, right? So I think it's gone up even a little bit higher, although earlier in the year, you had a bit of a tech pullback, as you saw, or as you stated. That's a big part of the market today that really didn't have the same kind of provenance if you went back 20 or 30 or 50 years. Now, concentration rise and falls, as I said before, that's really telling you about what the market thinks about these companies. But let me give you an example. I like to think about concentration not just as a point in time, but as it relates to performance over a time series. That's important. I'll give you a little anecdote that I think kind of helps illustrate this. So I'm sure the viewers, and many of them have heard of a company called Enron, right? We remember Enron back in the late 90s up into 2000. It was really seen as an extraordinary stock and company until it wasn't, right? It turned out to be some problems beneath the surface. Long story short, after incredible performance through 2000, Enron had a very swift decline, and it was in the 500. It was deleted, though, in November of 2001. November 28th, precisely, it was replaced with a different stock. If anybody could guess which that one is, they win a prize. And that stock was a company called NVIDIA. NVIDIA joined in November 28th, 2001. I'm not going to say it was a complete unknown. Right? People knew a little bit about it. But if you looked at the weight of NVIDIA, it was less than 10 basis points, right? It was ranked in kind of in the mid 200s and weighting next to another company nobody had heard of called Apple, right? Collectively, those two companies were 16 basis points of the weight in 2001. So it's hard to think about that now. We'll follow their history, right? And both of them underperformed the market over the following year, right? I think NVIDIA was about 50% worse than the S&P 500, the 12 months after it was included. So I bring this up because I say it would have been hard at that time to predict where we are today. What happened, right? Since that date of inclusion, NVIDIA has gone up 45,000%, approximately 29% a year. And over 32% a year for Apple is about 82,000% compounded. So big punchline. So it's easy to say today, look at these concentrated companies, how huge they are. But if you were along for that ride, if you were part of the index, or part of the, an index investor, and you're seeing two things happen. One is diversification, where, one of the 500 names falls out because of what's happening. There's another, 499 constituents to help balance that, including a new one that grew. And number two, as you're along that ride, that rise in concentration is another way of saying an increase in performance, right? NVIDIA's weight today is very large because it has performed extraordinarily over that period of time. The last thing I'll say in concentration that I think I've noticed that it's interesting is if you look at the weight of the top 20 today, it's about 48%, right? And 5 years ago, it was about 37. So that's kind of pure concentration increasing. But the relative, weight to the relative contribution to net income in the 500 is about the same. All right. So the companies are growing, but it's not just their prices are growing. They're contributing more. They're generating cash flow. What is an interesting metric, I think, recently is the weight relative to their CapEx spending. So today, these top 20 companies contribute about 46% of the CapEx. And a lot of that, because as you mentioned, they're tech companies, is AI driven, right? Infrastructure, capabilities, data centers, things like this that are flowing through. And so you could make the case that this high concentration, these are different kinds of companies with a different growth trajectory if you follow that AI story and around the kinds of earnings that many people in the market are expecting from the sector.
So interesting, the NVIDIA story, and I think it's important to have more of these stories to think back on when we get caught up in, it's so concentrated right now. Well, it shifts over time, and this is, not going to look the same 10 years from now. Some investors believe that S&P 500 index is all you need to own, or an ETF that tracks the S&P 500 ETF is all you need to own for a diversified portfolio. What are your thoughts on that? Or what would you say to investors who are sort of looking at the S&P 500 as a proxy for the wider equity markets?
Well, as you said, we're not giving investment advice, but I can tell you what the S&P 500 represents. And I think what I hear from investors around the world when we go talk to them of why they're including, the 500 in their holdings, whether they're in, Mexico or Japan or Europe. There's obviously this diversification component we talked about, right, with the 500 names and the way that's managed over time. There's a lot of liquidity there, right? You talked about the liquidity of the underlying, which flows through to liquidity of, typically S&P 500 related instruments, right? Whether ETFs or futures. These are some of the most traded instruments in the world, more than any stock, even in fact. And finally, I think from a diversification standpoint, we should talk about revenue, right? These are 500 companies that are domiciled in the U.S., but only 71% of their revenues are coming from the U.S., right? So inherently, you have global entities, large cap, that are drawing about 10% of their revenue from Europe, another 10% from Asia, and the rest from other sources. So even though this is a stock index that is built from U.S.-based companies, these companies themselves are all over the world. And I think one of the expressions of that, going back to AI, for example, is that you see sectors, which I know you also are engaged closely with, within the sector landscape. One of the best performing sectors this year beyond tech, which we understand, is utilities in the U.S. And that may strike people a bit when you have a tech run and you see utilities do well. It seems very domestic, but in fact, one of the biggest contributors to utilities performance is an energy company that has signed multi-decade agreements to provide renewable energy for data centers, fueling AI, right, from renewables. That flows through. And so you have these vertical sectors and that are diversified geographies, but also themes that run across not only the U.S., but the global landscape that I think are one of the main reasons an index like the 500 is popular around the world.
Very interesting. Yeah, super popular. There's a lot of different ways you can get access to the index. You can't invest directly in an index, but you can buy an ETF that tracks the index. In Canada alone, I don't know, I can count 10 just off the top S&P 500 index ETFs. I'm sure there's plenty more. BMO ETFs has 3 broad-based exposures: ZSP, our S&P 500 index ETF, ZU, which is the hedged version, and then ZSP.U, which is the US dollar. So lots of different ways to access this index. I think there's sort of 3 points on I guess, why BMO. Number one would be scale and liquidity. These ETFs are amongst the largest and most liquid in Canada, over 20 billion in assets and hundreds of thousands of shares that trade every day. As Joe has mentioned, these indexes, or these ETFs that track these indexes, are very highly traded. And what does that mean for investors? Tighter bid-ask spreads and more efficient trading when it comes to your portfolio construction. The other thing I want to highlight is tax efficiency and the benefit of going with a Canadian listed option over a US listed option. There are some tax considerations for Canadian investors when it comes to US estate tax if you're going to go over and buy a US listed ETF. So that's something you should talk to your accountant about and consider. And then last thing is the currency conversion costs. I think the last estimate that I heard was that it's about 1.5% on the buy and 1.5% on the sell in currency conversion costs that you're paying each time if you were to convert to USD and buy a US listed ETF. So again, having the flexibility of a Canadian dollar version that trades here in Canada is a great option for Canadians. So we spent a lot of time talking about the S&P 500, but I do want to get to, I guess, this is one way that we can invest in indexes, right? We can also invest in international or Canadian indexes as well. And we've seen this passive investing just rise like crazy with the invention of ETFs over the past decade or two. But I want to get into SPIVA. Joe, we've had you on in the past. This is a scorecard that measures active versus passive investment performance over time. So give us an overview in terms of what the scorecard is and how it actually looks to measure this.
Sure. So what the scorecard is, if anyone's new to it, SPIVA stands for S&P indices versus active. And as you pointed out, Aaron, I think with the growth of ETFs, a couple of decades ago, people started to ask in the industry, how do these index approaches compare to active managers, right? If you're getting average, I remember there was one ad from an active shop saying, why would you want to be average? Well, the answer is average does pretty well compared to the rest of active world. And so we compare active funds in different domiciles, including Canada, to benchmarks that are appropriate for them and that are in the same currency, et cetera. And one of the key things we do in SPIVA is we look at survivorship, for example, right? So if we're showing you a 10-year number of how many managers outperformed, we're including the funds that existed at the beginning of that period, but still don't at the end. And in fact, in many cases, that can be anywhere from 20, 30, 40% or more of the funds disappear over time. So that's a big factor from an investor standpoint. We look at the appropriate, apples to apples benchmark. We look at asset weighted and equal weighted returns, right? So bigger funds versus all the different funds in the market. And we choose the share class that has the most assets in it. So if there are funds that have multiple shares, we try to keep that clean and also do a lot of cleaning of the data, taking out funds that might be a leverage strategy, which isn't really a true kind of stock picking approach. And so you end up with SPIVA, and we report these results at this point twice a year. We do a mid-year, which I have some of the data with today that covers the first 6 months of the year, and then a full year report describing how many managers beat the indexes and why. We try to cover what's happening as well.
And it's 20 years of history on this report? Or?
We started in the U.S. in 2002 and added other regions along the way. Right now, we cover every continent except for Antarctica. Right, we have about a dozen or more reports. I don't know exactly when Canada started, but it's been quite some time. So there's good history there.
All right. It's been a very interesting year this year. I guess we say that every year, but it does feel like an interesting year. But what do the latest results say about the performance of active versus passive?
Sure. I mean, I'll share a few. Let's start with the 500, right? Because we're talking about that today. And as you pointed out, since there are, the 500 lives in many different markets, there are also U.S. equity managers, including in Canada, who we compare it to. So this year has been interesting in that, in Canadian dollars anyway, the 500 was not up very much over the first half of the year. It was just barely, not quite 1%. You had a lot of other markets doing well. But when you compared active managers of U.S. equity, domiciled in Canada, we found that 71% of them underperformed over the first half of the year. So it kind of puts a bit of a test to the notion that in a weaker market, managers do better. Sometimes we see that a little bit directionally, but not enough to make a long-term difference. Again, speaking of the long term, when you go out to 1, 3, 5, 10-year horizons, you're seeing 85% underperform over 1 year and out to the high 90% over 5 and 10 years, right? So we do see this kind of convergence too across different markets, different asset classes, where you can have a short-term period where some managers do relatively better, but over the longer periods, it becomes increasingly difficult. Those are some of the highlights. I think also we'd find that, in the market itself, if you look at U.S. equity stocks, because this is kind of the opportunity set for those U.S. equity managers, right? Over the first half, just over half, about 56% of stocks underperformed the S&P 500 itself. And when we talk about those numbers, that's really where we're getting into a discussion of what we call skew. If you think about, like I said, the NVIDIAs, the Apples of the world, these big stocks that have had incredible performance, when that happens and they have a large weight, and this happens in Canadian equities as well, that pulls the average up such that the majority of stocks are underperforming. So you're already starting with, from a probability perspective, a very difficult landscape for an active manager to pick winning stocks. And the fact that 71% underperform and 56% of stocks did tells you that essentially they're doing worse than random over the first half of the year. They're not alone, but it would have been better just to randomly pick stocks than to engage in whatever was actually happening at that time.
Very hard to pick stocks and do so consistently over time. How do the SPIVA results vary across the different geographies? You talked about U.S. equity, but are there any differences across geographies and asset classes that you see that are notable?
We can look at some of the geographies in Canada, for example, right? We cover not only the U.S. equity funds, but also Canadian equity. Similar results year to date, right? In fact, for Canadian equity, when we benchmark against the TSX composite, we'd see about 70% of funds underperform, and it gets up into the 90s as you go further out. International equity, right? It's also been about 86% over the first half of the year, again, going up to the 90s further out. Global equity, same story. It's above half now and gets worse. One area that stood out a little bit in Canada, at least over the short term, is in the Canadian dividend and income equity category. We only had 44% of managers underperforming over the first half of the year. And that's noteworthy because those percentages do get, like everywhere else, much higher into the 90s going further out. And we see this from time to time in a market like in Canada or elsewhere, where there might be one stock. In this case, there was one of the large names in the underlying index that had about a 35% drop during the period and was removed from the index. And we found that many dividend and income managers did not own it. So that was a source of outperformance for them over the short term. But time will tell how that cascades through the rest of the year. But again, the results tend to converge similarly in international equities and fixed income as well over time.
I encourage everybody to check out the website. We'll put it in the link below, but you can also just Google SPIVA, and it's the first thing that comes up, and you can look across all the different geographies and asset classes. Very interesting. They also have a persistence scorecard that shows, over time, if an active manager does outperform, what's the probability that they'll do so in year 2 and year 3. So all of that is on the website. You can check that out. Thank you so much, Joe. Thanks for joining me today and providing all your insights. Very interesting. Thanks to our viewers for tuning in today. Please remember to subscribe and share this channel so that we can continue providing you with videos like this. That's all for today. We'll see you next time. Bye for now.
Thank you for tuning in to this week's episode of ETF Market Insights. Don't forget to hit that subscribe button and sign up for alerts so you never miss our latest content. For more insights and to keep the conversation going, visit us at etfmarketinsights.com. Join our mailing list and explore a wealth of resources and tools designed just for ETF investors. Until next time, stay informed and empowered in your investing journey. This session is for informational purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or a recommendation to buy or sell. Particular investment and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to your unique circumstances.